All right, let's get stuck into strategic home loan refinancing in Australia. We're going beyond just, finding a slightly cheaper rate today.
Exactly. This is about making refinancing work harder for you, aligning it with your bigger financial picture.
So it's not just transaction then, it's more like a strategic move.
That's the core idea. It's less about the headline number and more about, well, what are you actually trying to achieve?
Like paying the loan off faster,
Mm,
or maybe pulling out some equity.
precisely. Or consolidating other debts, maybe higher interest ones.
Hmm.
Refinancing is basically a tool in your financial toolkit. How you use it depends on your long-term goals.
Okay, so thinking strategically is step one. What about the planning before you even approach a lender? Where do you start?
Number one has to be your credit score. It's fundamental.
That's critical.
Well, lenders see it as your risk profile. So a higher score generally means better terms, better rates for you. You should be aiming for, say, 650 plus if possible.
And that means things like paying bills on time, reducing other debts.
Yeah, the basics. Consistency is key. And then you absolutely need to understand your current loan. Really get into the details.
Not just the monthly payment amount.
No. Know your rate fixed or variable, your remaining term, the exact balance, any fees you're paying now, the features you have.
Like offset or redraw.
Exactly. And crucially, if you are on a fixed rate, you must know about potential break costs. Ending that fixed term early can cost you sometimes quite a bit.
Right, that could wipe out any savings.
Yeah.
Okay, what about using home equity? That comes up a lot.
It's a major advantage. More equity generally means more options and potentially better rates. Understanding your LVR, your loan-to-value ratio, is essential here.
That's the loan amount versus the property value.
Correct. Keeping that LVR below 80% is really important, mostly to avoid LMI, lender's mortgage insurance.
Which protects the lender, not you.
Precisely. And if you can get it down to 60% or even less, you might unlock even better deals. Now, you can do a cash-out refinance using that equity, but just remember, it does increase your total loan amount.
Okay, so planning's done. Now you're looking at offers.
Yeah.
How do you see past the advertised rate?
Always look at the comparison rate. It includes most of the standard fees, giving you a truer sense of the annual cost.
That's through the marketing a bit.
It helps, yeah. But also, look at the features. An offset account, for instance, can save you a huge amount in interest over the long run, maybe even more than a tiny rate difference.
That makes sense.
Yeah.
And should you automatically jump ship to a new lender?
Not necessarily. Always talk to your current lender first. Negotiate. You've got history with them. They might want to keep your business and offer you a better deal. It's worth asking.
What are the potential traps or downsides to watch out for when you're actually making the switch?
Fees, definitely. Application fees, valuation fees, discharge fees from your old loan, and those potential break costs is again if you were fixed. Also, if refinancing pushes your LVR back over 80%, you could be up for LMI again.
And debt consolidation, you mentioned that earlier as a goal, but are there risks?
There can be, yes. Rolling short-term, high-interest debt like credit cards into a 30-year mortgage might lower your monthly payments now, but you could end up paying way more interest over the entire loan term. You really need to do the maths carefully on that one.
Got it. How long does this whole refinancing process usually take?
Typically around 30 to 45 days, though some simpler ones, rapid refinances, can sometimes be done in just a few days, maybe a week.
Okay, so you've refinanced. Is it set and forget then?
Oh, definitely not.
Oh.
You need to keep an eye on things, track your progress, watch interest rate movements like the RBA rate changes, see if new opportunities pop up.
And actually use those features you chose, like the offset account.
Absolutely. Maximize them. And critically, keep your finances stable, make sure repayments are comfortable, avoid racking up new debts unnecessarily.
Are there red flags that signal it might be time to look at refinancing again?
Yeah, if your variable rate starts creeping up significantly or if you're genuinely finding it hard to meet repayments, those are clear signs. Time to reassess.
And what about getting professional help? When is that a good idea?
Look, it can be complex. Comparing features, understanding costs, navigating LVRs, a good mortgage broker can provide expertise and access to more loan options. It's especially useful in tricky situations.
Like for expats?
Exactly. If you're an Australian expat refinancing from overseas, it adds layers of complexity, different lender rules, tax implications maybe. Specialist help there can be vital.
So pulling it all together, strategic refinancing is much more than just chasing a low number. It's about consciously using your mortgage to support your wider life goals.
Right. It needs that upfront planning, careful choices during the process, and then ongoing attention.
It really makes you think, doesn't it? How does your current home loan actually fit into your long-term plans? Is it just a debt you pay, or is it working for you strategically? Are you thinking short-term fix or long-term financial architecture? That's the key question. And if you are an Australian expat navigating this from abroad, remember that Odin Mortgage specializes in helping expats find competitive home loan deals in Australia.